Hi viewers, and you're watching the Mortgage Busters show. I say the same every week. We help you, we bring the professionals in to talk about and show you how to pay down your mortgage so that you can go into the bank and say, you know what, this is my last payment on my home loan. There it is. Now I'd like to have the title of my house in my hands so that I can put it away in a safe place. That's a great feeling to have, and a great thing to do is to own your own home outright and to have the title, and it's all yours. No one can take you away from it. My name's Greg, and today, or in this show, for the whole show, we've got our finance guru, Stephen Hudson.
G'day, Greg. How are you?
Steve, welcome to the show.
Yeah,
Very well, thanks.
Yeah, I'm pretty excited. What a week it's been. You know, with the 1,000-day Mortgage Busters Challenge, we've been very busy, and we've been helping a lot of Australians to, bust their mortgage.
Bust the mortgage. That's what it's all about. And, all you got to do is pick up that phone or go onto the internet to our website, tmbshow.com.au. In other words, the mortgagebustershow.com.au. Register to participate in the 1,000-day Mortgage Busters Challenge. You've got nothing to lose. In fact, you've got everything to gain. Pay down your mortgage quickly, and also $1,000 bonus.
That's right. How can we forget the $1,000 mortgage bonus for the 1,000-day Mortgage Busters Challenge? How beaut's that?
Fantastic. If you're one of the first 100 that enroll into the program, and we're not too far away from there at this point in time, but there's still room, so you can jump in, register for the program, and Mortgage Busters Show will make a $1,000 payment on your mortgage just for participating in the program. So, Steve,
Greg,
what have you got for us today?
Yeah, today we've spoken a lot about the thumbprint report on the show over the last few episodes. Today we'd like to have a bit of a detailed look at that.
Sure.
But first, being part of the Mortgage Busters show, you're always looking at opportunities to see what people are offering to reduce your mortgages and so forth. The other day I came across an example on social media, and I was flicking through Facebook, and pay off your mortgage in 6 years. So I had a look at that, and I just thought I'd like to bring that to the table today before we get into the thumbprint, and probably use some of that to go into the thumbprint a bit later on in the show, and just see how some of these little formulas work. Now, one thing I will say, Greg, is debt is debt, okay? If you've got $200,000 worth of debt, there's no magical formula for you to pay $1 down and reduce it into $2 or make it into $2. So it's debt is debt.
So if you take out a loan for $200,000, you've got to pay back $200,000.
Yeah. Doesn't matter what the magicians say out there that we can reduce it and make it go away. You still have to pay that money. Now,
agreed.
You either earn it or you win it, whatever form, you have to pay that lender back the money. The interesting part is the interest. That's where you can save money. You can either reduce your interest by changing loan product to a lower interest, or you can pay off more or have an offset account so that you're not being charged the interest, so the money that you are going to pay is coming off your principal.
And we've spoken about the offset before.
Absolutely.
But in general, I was told, and I see the numbers almost daily, you usually pay back about 2 times what you've taken out. Like if I've taken out a loan of $200,000 and I just pay my loan back as the bank requires me to monthly or whatever, I would end up paying about $600,000 back. Is that about right?
If you look at historical interest rates and the way they've been structured over the last 20 to 30 years, yes, you're right. Currently in Australia, the interest rates are historically low. It's in fact the 4 big banks at the moment. I think one of them's got a 3 or 5 year rate that's the lowest they've ever put out in the marketplace.
Wow.
So now it's double, right? If you take a $200,000 and interest rates stay the same, it will be $400,000.
Paying back $400,000.
But with interest rates historically, they've been up. I've seen them at 17%.
Yeah, I have
so
too.
if you take the average, you're probably quite right that over a period of a lifetime of a loan, you could $200,000 you end up paying $600 back.
So on that basis, if you take $200, if I borrow $200, I have to pay my $200 back.
That's right.
But I don't have to pay $400 back. I can work on that interest.
You can work on the interest through the things that we said in one of the episodes was, you can have an offset account.
Yep.
You can make the fortnightly payments or weekly, which you're actually paying more.
Yep.
Right. And then any
Extra one-off
payments, you get a tax return, or you get left some money, you can pay that in. But the one that really deals with interest is the offset account.
Yep.
Okay. So you'll never move away from an offset account. Always offset account. It's number one thing. And how many people do not have offset accounts, or they've got an offset account and not using it is
That's
quite
what
interesting.
surprises me. I see many people on a almost a daily basis, and quite often they've got the offset account, but they're just not using it, or they don't know how to use it.
They don't know how. And look, the story we talk about, one of our clients who was prepaying the electricity bill.
Yes, yes.
And while that's great behaviour to have, that money should have been sitting in the offset account and paying off their mortgage,
saving them money, saving them interest.
Yeah. So look, coming back to the Facebook advertisement for paying off your mortgage after 6 years, we've prepared something a little bit earlier.
The whiteboard.
The whiteboard. Yes. So get your calculator out, Greg.
All right.
Fire that one up. That's a.
Yep.
You got that? So
got the calculator up.
Very quickly, we want to go through this. I know we're running into the first break, but we've got a scenario here. The client's got a car loan, credit card, a personal loan, and a home loan.
And that's pretty typical.
That's typical. When we walk into a household, that the numbers might change a little bit. In fact, probably quite a bit, particularly on this one here, where they do have these type of debts. Okay.
Yep.
So these are the balances. Current balance might not be the original amount, but that's what's owing, and that's the current payment.
Right.
Okay. Now in this scenario,
so in that first one, the remaining balance on their car loan is $3,000.
Correct.
And they're making weekly or monthly payments
of $300.
$300.
Now in this scenario, they were asked to pay an extra $268 per month on top of their payment. So again, there was no magic in this, that your debt wasn't going to just disappear.
Right.
They're asking you to actually put in more payment than you currently are.
Right.
So that is the first thing that they made.
Okay. So that's okay, because it's not so much that people might not have the resources, it's just they don't know what to do.
Okay.
Yeah.
But debt is debt.
Yeah,
interest
correct.
is interest.
Correct.
So the first situation was that we were paying $568. So you're adding that money, the $268 to that to get to $568.
So $300 plus $268.
So
is
you
$568.
pay off your first loan, and that is then 5.3 months, and in years it's 4.
Okay, so let me just check that. So I'm going to divide 3,000. Divide that by 568.
Correct.
Which is 5.3 months.
Yeah.
Okay. So Steve, we have to go to a break.
Yes, Greg.
But we'll come back after the break, finish this table off, look at the thumbprint, and a lot more exciting stuff. So viewers, come back to us straight after this break. Ladies and gentlemen, you're watching the one and only Mortgage Busters show. We're with Steve Hudson, who's taking us through some typical numbers.
Numbers,
Steve,
Greg. Whiteboard.
It's all
Beautiful.
about the numbers and the whiteboard, of course it is.
All right, just in summary, this was an opportunity to be able to pay off your mortgage over 6 years. We've taken a hell of a lot of numbers out of that, but the request was that you pay an extra additional $268 per month over the current repayments that you're making.
Okay, so someone just said, like a finance planner or someone said, okay, you want to pay your debt off quicker, you've got to find $268 from somewhere, and that'll get us going.
Debt's debt. So the only way to do it is to accelerate that debt, is pay extra. So with this, your payment was $568 over this car loan, which the balance was $3,000, payment was $300. So we're going through the numbers, 0.4 of years to pay off.
Okay, so just to keep it clear, the balance on the car loan was $3,000. The monthly payment was $300, but they said find another $268.
Correct.
So now they're paying $300 plus $268, which is $568.
That's right. So the next one, the credit card, we've got a balance of $5,000. They're paying $300 off per month. So we add that to that. So if my maths is correct, is $868.
Okay, so that happens after the 5.3 months. After they've finished paying off the car loan.
We could put a line through that. So that's finished. Okay.
Yes.
So the three debts are left.
Right.
But you're
in fact, put a red line through it.
Put a red line through it.
Yeah, because now we know that that's finished, and the new payment on the credit, or the payment on the credit card is $300, but we're going to use the $568 we were paying before as well.
Onto the credit card.
Yes.
Months to pay off is 5.8 months,
Yep.
which should be about 0.05 years.
Let me just quickly check that.
0.5 years.
Correct.
Okay. So personal loan. So we go put a line through that.
Yep. That's off the list.
So we've got a personal loan, which is $20,000 repayments, and that's the balance current.
Yep.
So 320. We add that to the 868
That we were paying before. Yeah.
before. So that should be 811, and we're going to pay that into the 20,000.
Yep.
That will take 16.8 months, which is 1.4 years.
Years. Yep. I've checked that one.
Okay. So we put a line through that. We've paid that off. So the home loan. This is interesting, Greg. $100,000 home loan. It's not bad, is it?
Not bad.
So according to the assessment, it was $1,000 per month they were paying. So we're going to add that 1,000 to the 1188. So the 2188 is what they're going to be paying off on the 100,000. It'll take 45.7 months.
Yep, I've checked that.
Which is 3.88 years. Just fix this up straight away, Greg. So it's probably annoying you just as much as it's annoying me. Always check your numbers.
Yeah, so that should make that 6.1.
6.1, yeah. Let's just cross that out. 6.1 years. So we've got that. So the home loan is $100,000, currently paying off $1,000 per month. That makes that $2,188. We pay that into the $100,000. Takes 45.7 months to pay off, 3.8 years, and that corrected math is now 6.1 years. The interesting part about this, and why I wanted to bring it to the show, is that the viewers must be careful when they look at these things and people preaching how to pay off loans quicker. First off, there's nothing wrong in making the additional payments. We do preach that with the crunching. So, it's the same thing, 3 years, pay off as much as you can. But if we add this up, which is 128, is that the right maths there, Greg?
120, yes, correct.
Okay.
The total debt is 128,000.
If you were to actually refinance that into your mortgage and use that number, the final number, to pay off 128, you've got your calculator. How many years would that take?
So it's 128,000.
Yep.
Divided by 2188 is 58 months. Divide that by 12. 4.9 years.
4.9 years. So we're going to pay off 1.2 years earlier if we did that. If that's your motivation and what you wanted to do was to pay off your mortgage in 6 years, you could pay it off a lot quicker if you speak to someone about looking at consolidating your debts.
Do you know what? I'm stunned by that. Because anyone spruiking that type of approach is right. They've got a definite program, and it's logical, and you do get rid of one debt, then you kill the next one, then the next one. And that's all well and good, but you know what? You're right. If you, instead of doing that, you're actually 1.2 years better off by consolidating and paying it off
Absolutely.
at a home loan rate.
And in the next segment, we'll look at the thumbprint and how you can use that, paying that off quicker, right, and sooner than using the equity in your house to build real wealth, and what type of investments that you're going to need to do that. So let's just look at
That's really blown my mind, Steve. I have to tell you that, because you know what? If someone showed me that first one, I would have thought, fantastic, when do we start? When I could have always been 1.2 years better off.
Absolutely. Now let's look at very quickly get going into...
We've got 2 minutes.
2 minutes, okay. So let's look at a Mr. and Mrs.
Well, we had 2 minutes 1 minute ago.
All right, so we've got a minute to get somebody up. 38 years of age.
Yeah.
55K apiece. That's not...
They're earning 55?
Yeah, 55K for thousands. Tax on that per year, what will we be paying in tax there, Greg?
Well, at 50,000, I know they'd be paying 8,600.
8,000, so that's 922.
Oh yeah, that's about right. Yeah.
That's about right. And over a lifetime, if they're going to retire at 60, because they could probably work to an extra... So 568 in tax over their working lives together, assuming that their wages don't go up and the tax rates don't change.
All right, you know what we might have to do? We might have to go to a break before we finish this off, but that's pretty amazing. How many years? So from they're 38 years old, they retire. By the time they retire, between the both of them, they'll be paying almost $500,000 in tax. Viewers, stay watching. We'll be back to talk about how you can reduce that tax bill the right way on the Mortgage Busters Show. We'll see you after the break. You are watching the Mortgage Busters Show. Let me ask you a couple of questions. Do you have any idea how much tax you've paid since you've started working? Question number 2. Do you have any idea how much tax you will have paid by the time you stop working? Well, Steve, that's a chunky number, isn't it?
It's, as you said, it's getting on to your $500,000 there.
Well, your average Mr. and Mrs. 38-year-old, who are both earning $55,000 each, will, by the time they retire, have paid nearly $1,000 in tax. Yeah. Can you think of a better use of that tax?
Well, I can.
So can I.
There is legal ways through the current tax regimes right now to use that for investment.
Absolutely.
And get a rebate back from the government through it. Of course, you'd use a proper tax accountant to do all that. But with a typical mortgage of around about $350, when you stop and think of the interest rates now, you're paying more tax than you would be in interest over the life of a loan.
See, people don't. If you ask your average person, what's your biggest bill? They'll if they've got a mortgage, they'll say it's the mortgage.
Yeah.
But the tax never comes into it. It's never a consideration.
Normally it's my children's phone bill, but yeah.
Yeah, tell me about it.
So the thumbprint report. We go offer to our clients, our viewers, a free thumbprint report,
and that's what it looks like. Our thumbprint report. There it is. And of course, that's one thing we do work out in the thumbprint report.
How is it put together?
Well, first of all, the viewer or whoever needs to make contact with us, and then we'll go out and see them. And, it'll be a bit of a get-to-know-you session and a bit of a chit-chat.
Does it cost money?
No, nothing.
Nothing?
It's absolutely no charge.
Beautiful.
Free to do.
It's even better.
It's the best.
Yeah.
It's the best. So basically what happens is we'll identify the person or couple's numbers, their basic financial profile. Mm-hmm. We'll collate those numbers and we'll present those numbers to the clients in terms of where a properly structured and laid out financial profile.
So using our example up there, $100,000 and some of the debt that they've got, typically a couple at 38 with a $100,000 mortgage, property is probably worth around about $450. They might have about $500,000 worth of equity.
Equity, very good.
Could someone retire on that, do you think, Greg?
Well, if they do the right things, they could.
$500,000? Yeah, gotcha, yeah. In old cold hard cash, probably not. But if they invested their equity, and that type of equity would probably, just on equity leveraging, they could probably borrow around about $2 million plus. Of course, they've still got to be able to afford it, the serviceability part of it, but a lot of people don't think about that.
No, they don't.
It's equity sitting there that is dead to a certain extent.
Yes, it's like having, if they've got $500,000 cash in equity, it's like having $500,000 sitting here doing nothing.
Yeah.
You'd never, if you had $500,000 cash sitting there on a table, you would never ever consider that. You'd take it to a bank and at least put it into a term deposit.
Or the casino.
The casino?
So what's
remind me never to lend you $500,000.
That's all right, mate. Straight into property.
Of course, that's the sort of thing we identify. Yeah. We'll identify the couple or single person or whatever we're working with. Will identify how much tax they will have paid by the time they retire. Now, the government wants us to use that tax in a more in a better way.
So what do you think that a couple would probably need to retire on? What type of number?
Well, the minimum that the Australian Superannuation Funds the Australian Association for Super Funds of Australia says the average couple needs. It is a mouthful. $56,000 to retire, but there's a bit of a profile and a budget that goes with that. And in that budget, it allows for 2 glasses of wine each per week.
Wow. A lot of Australian households, that wouldn't hold up.
It wouldn't hold up at all.
So it's a pretty skinny type of budget.
It's very, very
So with
thin.
our couple up here on 110 per year, is there a formula that they should be looking at? 70%, 80%?
Yeah, well, a couple like that could easily set themselves up with $100,000 passive income in retirement.
Okay. So with that, how many properties do you think they might need?
It'd have to be about 4 or 5.
Five
Yeah.
properties. So 5 properties, around about $400,000 each, is about $2 million.
Yep.
Again, using the scenario that it is made up here, of course, of about $500,000 worth of equity, they could quite easily do that.
And this thumbprint report will identify that,
Yeah.
and it provides a foundation, a springboard, to which somebody can start off a program like that.
And of course, we're not advocating that they go out and buy $2 million worth of property.
No.
You do it in a responsible fashion. As we've said before, be investor ready, get your finances sorted, get your team together, one by one, put those properties together.
That's right. It's all about the right people.
Yeah.
And that's really the crux of what we do, is referring the right people with the right skill base, like yourself, who's an expert in finance, that knows all the strategies and the methods and the resources, where they come from, where to apply for this type of finance, where to apply for that type of finance, and put them all together so in a package, a client or somebody that wants to progress themselves financially can do so with confidence.
Yeah. So with buying, say, 4 or 5 properties, how they create the equity?
Well, just through growth.
Through growth, so time.
Through wise and prudent decision making.
Okay. So what property increases in value currently at what rate?
It's doubling in value about every 10.2 years.
Okay, so
Yeah.
it's about 10%. So even on a 5% return, they're going to be making.
Oh, absolutely. Look,
increase
there's in my view, and this is purely my view, Greg's view, is where I believe personally we're going into one of the biggest booms Australia's ever seen. That's my view.
Yeah, I actually heard that the other day. But yeah, it's interesting. There's a lot of people who do say that we're at the height of the property, but they said that before the GFC, and what happened with after the GFC. Shares went south, property stabilised, and they kept on growing.
We don't have enough homes. It's like Elizabeth Jackson said last week, she was on our show.
Yes.
And we're 1.4 million homes short of supply in Australia. It's something like that. But Australia, on a global context, is poised for growth. Everyone wants to come here.
Yeah.
Like she said, people are putting bathtubs to try and get across from New Zealand alone, let alone the rest of the world, Anyway, we're getting close to a wind-up. Steve, this is our financial thumbprint. If you're watching the show and you want to get this done, just make contact with us through our website, tmbshow.com.au, and make contact with us.
Don't forget.
I know it's coming.
Don't forget the 1,000-day Mortgage Busters Challenge.
Steve, take it away.
Oh, well, it's we've got the challenge there to bust your mortgage in 1,000 days. And for the first 100 people that sign up for the program and start getting going with us, $1,000 to be paid off your mortgage. Well, that's a great offer, isn't it, Greg?
There's I can't think of any better offer. All right. Well, again, thanks for watching. Thanks, Steve, for being on the show.
No, lovely. Yeah.
Thanks for watching the Mortgage Busters show. We'll be back again the same time next week. Have a great week. On behalf of Steve and myself, we'll see you then.